You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm your host, Kerry Lutz. Our good friend, Lobo Tiggre, is with us now. Lobo, great to have you back. And this is really a fortuitous time that we're talking because we get to discuss what we've been talking about for 10 years already, the demise or the downfall of Western capitalism, of dollar diplomacy, of dollar supremacy. It certainly seems like this is another nail in the coffin at the very least.
Yeah, interesting times, to say the very least. But actually, let's jump on what you just said. There's so many things coming together. We've got the war, the new Iron Curtain, the breakdown of international supply chains, de-globalization, on top of the still continuing fallout from the lockdowns, the COVID-19 lockdowns. And now we're seeing what is not actually the first case of systemic risk. It's kind of interesting how different and yet how similar this is to what happened with the UK in the gilt crisis. It's different in details, but it's very similar, I think, in sort of method. Like there is this little thing that people didn't think about, didn't look at, coulda, woulda, shoulda. What's happened with SVB, you look at the forensics and you look at borrowing long, lending short, and it seems like, well, duh. Where were the regulators? Where were the stress tests? Why didn't they catch this? That's the hearing I want to hear on Capitol Hill. Actually, I don't want to hear any hearings on Capitol Hill, but that's what they should be asking. Right? So here's this big confluence of events, and it's very tempting to say, this is it. This is the proverbial it. The brown stuff is hitting the fan, and gold bugs rejoice. We're all going to see gold go to $10,000, and all our dreams will come true. Well, in the first place, if gold goes to $10,000 quickly, that dream in dollar terms may come with a nightmare in terms of reality. What you see out your front window happening in such a circumstance is not going to be pleasant for most people. But I think, let's hold our horses here a little bit. I think it's premature to say this is it. It smells like it. It looks like it. Maybe it quacks like it, but we're not quite sure yet. The powers that be have been so good at kicking the can down the road. That is a lesson that I think is well remembered. Because if you go out and bet the farm now, because this is it, this is finally payday's coming, payback is coming for the bad guys. The good, hardworking, salt of the earth, hard money advocates of the world are going to be vindicated. Just remember, the Soviet Union was a massive internal contradictions, and it lasted 70 years. So don't want to rain on the parade too much here, but, it's my job to be a due diligence guy, not to be a cheerleader. And I got to say, it's exciting, it's interesting, but let's not get carried away.
Yeah, it certainly has the potential. But until we see how this shakes out, I'm not convinced. I've always believed that the final episode was going to happen overseas and that the dollar would be the last domino to fall. But, the system is fragile, it's volatile, and susceptible to these shocks because the hyper leveraging, we don't even know about the derivatives and the impact. We never heard any mention that SVP had a derivative portfolio. And I find that with the amount of security.
Well, and they were an award-winning bank.
Yeah.
Right?
Oh,
they were named one of the top U.S. banks by Forbes or something, just a few days before.
Yeah. ESG, right? And wokeness, they could be called the woke national bank, right? And they were pumping money into startups all over the globe, in China as well, as if China needed another shock to its system.
As if, and HSBC stepped in to save SVP UK precisely for this reason. It's really, here's something else that I don't hear on mainstream media at all. Like, people are talking about these issues, and they're even asking about whether extending the bailouts beyond 250K is really a good idea or not. To their credit, they are bringing up some important issues. But what I'm not hearing is, well, why was there a run on this bank? Why were so many people withdrawing their money? Why did they cause this squeeze here between long and short? And I don't know this. I mean, I haven't done the forensics on their accounts and things, and you'd have to talk with each depositor to know what his or her reason was. But I'm wondering if this isn't actually another domino from the FTX disaster. Like, these are techie people, right? And techie companies, and what were they invested in? What were their financial needs? And if they got squozen by the FTX, implosion, and they might need cash for other things, and you could see that snowballing. So this is just a theory. I'm not saying I know this is what happened, Carrie and dear audience. I mean, I'm just thinking, like, if SVB is the Bear Stearns moment leading to a potential Lehman later, it might actually be misidentified. It could be that FTX was the Bear Stearns moment, and this is just the next domino on our way to Lehman. So even though I just started out with a caution, like, we don't know this is it, it kind of fits this pattern where, at the very least, I think people need to brace themselves, because this could be it, as you say.
Very well could be. But on the other hand, panicking is not going to be the solution either. But I kind of look at it as like the implosion of a building. The explosions go off, and then for 5 seconds more, the building is standing, and then boom.
Yes, that's right. Or as the saying goes, how did you go poor? Slowly at first, and then all at once. And many things we could say, but actually, I think this is an important point. If you look at not just finance, but human nature, if you will, expressed in history, it often seems like there's trends, like things keep going in a certain direction, and they go and they go, and then they reach not just an inflection point, but a breaking point, and suddenly things go nonlinear. And if there's one, I think, highly reliable and replicable lesson from history, is just this thing, that you can't count on trends continuing too far, and you don't know in advance when you reach that breaking point. And loop this back into what's happening today, and I'm sure you and I and most of our audience has had this thought that the Fed, its track record is to go too far, to keep tightening until it breaks something. And lo and behold, something broke. Now, nobody should be surprised by this. And there's lots of talking heads on mainstream media talking about how, well, SVB was in a unique situation and had unusual concentration of these uninsured depositors, and most banks aren't like that, and unusual concentration in the tech sector where we've seen all the layoffs and, maybe FTX fallout, right? So it's unusual. It's one-off. But it's already not one-off. We've already seen other banks getting hurt. And okay, maybe they don't have 90% of these uninsured depositors, but some of them have 50, 60%, which is a lot. So, I mean, Moody's just downgraded a half a dozen banks for systemic risk along these lines. And I'll let you have your say, but I'm just saying, break something and systemic risk. You put those ideas together, and that's potentially a big deal. I mean, it's systemic risk was the excuse for the UK central bank, the B of E, to turn around and do QE, even as it was talking about QT. And this bailout here is essentially QE. And so even though the Fed talks about continuing tightening, not just hiking rates, but this QT going on, this, without them saying so, they're not admitting it, but systemic risk just reared the tiny tip of its ugly head. And the reaction was instant. And that tells us, I think, everything we need to know about what happens when systemic risk becomes bigger and more undeniable.
And this was like really a panic. Well, you always expect it's going to be a bank failure. It's going to take place over a weekend. But they jumped into action. They couldn't get anybody to buy the bank. That's what surprised me. Lobo, our banking regulators are kind of out of practice here. We didn't have a bank failure in the past 2 years. And the last time that happened, I think, was in 05 and 06 or 04 and 05. And then we know what happened after that. We had 150 banks fail.
Sorry, let me jump in on that because that's a really important point you bring up. There's all these people reassuring all the hairspray heads on mainstream media, and they're saying, look at this chart. Look at how low the bank failures are. There's nothing like what happened in 2009, 2010. Well, 2009, 2010 was after 2008. You have to have 2008 first. So it just, at the very least, it strikes me as ignorant, if not outright disingenuous. All this reassurance, everybody's got I'm not trying to promulgate a conspiracy theory, but it sure looks like that people have been given, the word that they need to be as reassuring as they can. We want to smooth this over, at least for this administration. I can imagine if it was a Republican in the White House, maybe the media would want to hype up the scare. But it looks like they're trying to be as supportive as possible right now. And I think they're throwing their customers under the bus. Their audiences are being, if not actively misled, I think at the very least egregiously left uninformed, or, well, we all know about liberal media bias. I just no need to beat that horse to death.
It exists.
It just strikes me as this is being a particularly ugly and dangerous for the audience case. Like they're going to hurt people. People are going to get hurt for believing that everything is fine.
And going back to the formation of the FDIC and Federal Depositor Insurance, I think initially it was like a couple $1,000, maybe it was 10,000 at the most. I don't remember. It's one of those New Deal programs that emerged after the Great Depression, when there were massive thousands and thousands of bank failures across the country, and depositors were left holding the bag. And it was very controversial because the more free market people said, hey, you're going to encourage bad behavior. The best way for people to avoid bad banks is to understand that a bank is tenuous, their financial situation, and not put their money there. But here, you're making every bank deposit in the country up to the amount of the guarantee homogenous, risk-free, effectively. And then where do you stop it? Because, well, the people who really have money, if they're wiped out, then it's really going to wipe out the economy. And that's exactly what has happened here, Lobo. The Dukes of Moral Suasion have won the game.
Dukes of Moral Hazard. It's funny, I saw Larry Summers jumped on this pretty quick. And he's a Democrat. He worked in the Obama administration. But he has some intellectual integrity. He has been calling out the Fed, or had been before, and not towing the party line. So I have some time to Larry Summers. He's not stupid, and it's interesting. But he did say, this is not the time to be lecturing people about moral hazard. You got to do what you got to do to, keep things stable. But in my view, well, in the first place, when is it ever the right time to, if there's a problem that requires emergency action, you're always going to say, oh, this is not the time, this is just an emergency. We've got to do what we've got to do. It was like, George Bush saying, I believe in free markets, but we had to suspend the free market to save the free market as a result of the crash. Like, when is there a time where the politicians won't use the emergency of the day as an excuse for doing something that is bad? It's going to be harmful. This is not the time to talk about moral hazard. This is precisely the time to talk about moral hazard, because even if you assume the best of intentions, that the goal here is actually to help people, well, that's why you need to remind people about unintended consequences and how moral hazard is like, the king of unintended consequences in terms of drivers of, human psychology being what it is, systems being gamed, and bad outcomes. I can't say that I was there when they implemented the FDIC. My beard isn't that long and that white, so I don't remember what they started out with, but I know it's been increased. And I know that the guys who thought up, or I understand that even, the Democrats are on that side at that time. They understood that if you just guaranteed all depositors, that there would be moral hazard, that this would encourage reckless behavior. So you set the threshold deliberately low. So it was just mom and pop, the little guys that got taken care of. And the fat cats would be assumed to be smart. If they've got so much money, they'd be smart enough to look after themselves. And ratcheting up that ceiling has has blown that away, really. And right now, even though they say, oh, it's just one off, oh, it's just this one case, it's very hard for me to see how they bail these people out. And if there's another bank failure or a wave of bank failures in the future, that they say to those people, oh, screw you. If that was just a one-off, we're not doing it. How do you tell voters that somebody else gets a bailout, but you don't? So I think, de facto, this pushes them, the political reality is that there is no $250,000 limit anymore. And that has huge moral hazard because you're going to,
Yep.
I remember this. I remember this as when I didn't have $2 to clink together in my pocket. Did I care about how sound the bank was? Did I even look at the bank's track record or history? No. It was, if anything happened, I'd be covered, and, I would never have enough money to worry about that. Now, do I research my banks? Yes. I know this from personal experience, how that switch flips, and they have just taken the safety switch out of the system. That cannot be a good thing over time.
No. And I was doing a little research while you're speaking. The original loan guarantee, deposit guarantee rather, in 1933 was $2,500. They then increased it a year later to $5,000, and it remained at $5,000 until 1950 when they raised it to $10,000. All right, and now they've been raising it ever since. I mean, I remember when it was 50, 100, and what it does is it divorces the depositors from having an interest in how the bank is operated as long as you're under the guarantee. And in the good old days, when a small bank went bust because the president took off with all the money in the safe, or there was an embezzlement or whatever, it broke the whole town and everybody lost. Everybody shared the losses, not necessarily equally. Now we have socialized the losses, but it has gotten rid of an important counterweight on reckless bank lending and reckless bank investing. And it's all part of the deregulation, Lobo, that set this in motion. In addition, places like Goldman and other large brokers became banks during the last financial crisis. If you remember, they filed their bank charter, so then they were able to go to the discount window and they were able to get deposit insurance, all these things.
Right.
American Express became a bank last time.
Don't just survive, thrive. The Financial Survival Network.
Oceano Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Oceano's district-scale land package is situated near 2 producing gold mines, one of which Oceano's management team previously developed and sold to B2 Gold. Oceano's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Oceano has an excellent shareholder base, with Ross Beatty owning 20%, insiders 5%, and Resource Capital Funds 8%. This is an exploration company with drills turning that you'll definitely want to pay attention to. Oceano trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to OceanoResources.com. That's OceanoResources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Right. And you have these systemically important banks, too big to fail, right? Basically, the bar has been lowered for too big to fail now. Basically, everything's too big to fail. We can't allow any bank to fail because it's going to hurt or it's going to wipe out a town or a region or something like that. But let me rewind to something else you said earlier. Basically, this is a form of socialization of the banks. Because if now the government is on the hook for all deposits, it's the ultimate guarantor of all banks. Basically, these are becoming government banks. Because what happens when something needs, you step in. So, the government is now running SVB. And so, that's the end game here. And I mean, I'm not saying it's a deliberate end game, but that's where this road heads. And that's not a destination that has been good for anybody in any country where the governments have nationalized the banks. It's always a disaster.
Always. And effectively, the banks really were nationalized during the last financial crisis.
Case could be made.
They no longer really exercise any true freedom other than which reckless investment or derivative to buy. But outside of that, the government tells them who they make mortgages to. All the mortgages in the country are pretty much socialized now, except for the largest jumbos. The investors, what happens is the loans are guaranteed, and your big banks will make the mortgage, and then they sell it in the secondary market to so-called investors. Who's investing in those mortgages? Well, I think the Federal Reserve owns a large chunk of them. If anybody's got any research on this, I'd love to hear your research, find out more about it. But basically, the banking system was socialized long ago, and now we're just coming to terms with the ramifications of that. So banks, you say you're researching banks now before you put money in it. What do you look for? How do you decide if this bank is too good to fail?
Well, as we've just said, if they've all been socialized, I'm not sure any really qualify, but and my choices are rather limited here in Puerto Rico.
Mm-hmm.
So I can't say that I'm really happy with my due diligence, but I did actually, in selecting my current main bank, I did consult with other people that I knew that had accounts there and talk to them about their experience. Like, it's not actually boots on the ground kind of due diligence. But, as we've just seen, financial statements can be massaged and numbers reported. But, okay, so I do kind of just look at the general thing. Is this, what can I tell from my online search, from my Bloomberg terminal about this bank? And then my extra bit of due diligence was to talk to actual people who did business with the bank. And like I say, honestly, I really only had a couple choices. So I chose the least scary bank, and that was as good as I could get. But other people have more choices, and I do encourage them to, take this responsibility on.
Yeah, you can't be totally sure, though, is the point. And I think that's something you need to spread your money around in a few banks. Some people have said credit unions are great. They have big capital positions. I mean, I used to have a bank that I used in New York. They had a 32% capital ratio, unheard of in the banking world. And eventually they got taken over because they were just sitting there, low cost of deposits. They were a one branch bank. But the fact was they used Chase as their correspondent bank. They were in T-bills, everything else. So no matter how careful you are about your bank, the currency risk, there's nothing you can do to get rid of that except some precious metals, right?
Right. Well, yeah. So, and then, if it is actual systemic risk, even the best banks can be rocked by that. The best, most conservative banks can be rocked by that. You're in that context. You play by the rules of the man. And when the game becomes, Hunger Games, then, what do you do? But yes, actually, so gold and silver, quick jump in here. I was really, really happy to see the price action on silver yesterday. As we're recording, and it's Tuesday, yesterday, Monday, there was this big pop over 1900 in gold. And that seemed to make sense, right? There was fear. People rushed into gold. No surprise. I mean, happy to see. It's good to see that confirmation. It's not just a pet rock. It hasn't, gold 2.0 hasn't pushed old-fashioned hard physical gold out of the way. It's still doing its job as a safe haven asset. But as I think you and I have discussed before, the use case for silver is changing. Its industrial side is becoming a more and more powerful driver for its price fluctuations. But it's still a monetary metal. It particularly, in much of the world, it's still regarded as money. And to see silver really react on, not industrial news, not anything else, but react as a monetary metal should, and the other monetary metal did, was very encouraging. Because part of my thesis has been that silver is actually the win-win metal. If we're looking at a circumstance of stagflation and safe haven demand pushing the monetary metals up, and then you see industrial constraint potentially squeezing silver supply, since it's mostly a byproduct from copper and other mines, right, that we could see one of these magical moments where supply and demand imbalance in silver really pushes silver prices higher. But that also, hinges partly on the industrial side. It still needs to act like a monetary metal for that to work. If it's just going to become a different color of copper in the future, then that squeezes off from the safe haven demand. And that's why it was really quite reassuring to see silver react so strongly as a monetary metal yesterday. It's game on for me. I'm still looking for good silver stocks where I can find them.
Hey, and maybe one day those explorers will really pay huge dividends. That's what I'm expecting. So 3 things that you're an individual investor you should be doing right now, as well as an individual depositor. What should you do right now?
Well, probably our audience doesn't need to be told this, but if you don't have physical bullion, savings, I don't see gold as an investment. I just had a debate with this online with somebody, but it's not a speculation. I don't buy gold because I think the price is going to go up, or really the gold dollar exchange ratio. And it's not an investment. Gold doesn't generate income in general. I buy it because it is gold. It's a financial asset that you can be long without a short. There's no counterparty risk, and it still works when the electricity goes out, unlike gold 2.0. So that's always there. But if you're not adequately exposed, and I think you should have, at the very least, a few months of living expenses in bullion, like in your back garden buried, or whatever form of security you want to practice. I don't want to discuss my own. That you should have as just prudence. Never mind what the gold dollar exchange ratio might be. To have that, to be able to sleep at night, that you have that backup for no matter what else happens. In just a few months is the bare minimum. A year or two's operating cash would be much better. And well, how much is that if inflation is going up? Well, that's the point. If it's gold, it automatically adjusts for inflation because it's real. It's not fiat, right? So that's one thing, But in this context, I think, despite today's lower CPI print, I do think a CPI plateaus at a much higher level than the powers that be imagine possible. I don't think we're going back to 2%. I think that's a fantasy. If the Fed really did keep its foot slammed on the economic brakes hard enough to bring CPI and PCE down to 2%, I think that, the little bit of breakage that we've seen so far, the break something becomes a break a lot of somethings. I just cannot see, I may be wrong, but I cannot see that happening without a huge amount of damage. So, and we've already seen that they will ease up on systemic risk. So I don't think they get to their 2% goal. I think we settle at some higher level of inflation, which is not acceptable. And yet we still have economic weakness, stagflation. So I do think the gold dollar exchange ratio and silver will go up. And to speculate on that, that's where the stocks come in. It's very separate from the bullion I own. If I think I know where the market's going and I want leverage to that movement, then that's why I've become a stock picker. And the one thing I would say too is don't be lazy. Maybe this is the third thing. This is not a time, I think, for ETFs. The inflation monster is having its impact on the producers and the developers. We've seen huge cost blowouts. And it's not like, it's not the 6, 7, 8, 9% inflation that we're seeing in the advanced world or so-called developed world. It's way more than that. Your steel costs, your trucks and things, these costs are going up like 30, 50%. And that's your input costs, and your labor costs are way up. So you just don't buy the ETFs. Sorry, even our best friends ETFs for the companies. I think you want to be a stock picker. We just talked about due diligence on the banks. You want to make money. You want to make millions of dollars on this hopefully big move in the metals. Then don't be lazy. Do your due diligence. Find the better companies. Don't pile money into the ones that are struggling right now or are visibly in trouble. A turnaround story, it's a wonderful thing when it happens, but it's very rare. And if things are getting worse on the operating end, then you need to be focused on the ones who are succeeding. They've got the goods, they're delivering to the bottom line, or they're on time and on budget for their mine building project, or they're an explorer that's got visible success and progress.
I totally agree with you. I couldn't have said it better myself. Hey, Lobo, just tell us where we find you on the web, how we connect with you, and subscribe to your publication.
Sure. Well, obviously, I've just talked about picking stocks, and I would love it if people would hire me as their consultant to help them with their due diligence, and I have services for that. But for those who don't know, my suggestion is just sign up for the free weekly letter. If you do, we will not spam you with a flood of daily advertisements, and you really just get that one email per week, and you can see how I think, how I work, what I'm doing in general terms with my own money, and decide whether or not I can be your due diligence guy.
Perfect. All right. And if you've got a question for Lobo or myself, email is kl@kerrylutz.com. And make sure you go to the site, financialsurvivalnetwork.com, sign up for your free weekly newsletter. And Lobo, will be talking to you more later. Thanks so much for stopping by.
Thank you, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.